Wondering how you can build some equity in your home? Well, today that's what I'm going to talk about. Hi, my name is Mary Schumann. I am a realtor in Minneapolis, Minnesota, and every week I do videos about all things real estate and life in the Twin Cities. And if this is your first time visiting my channel, I encourage you to go ahead and hit the subscribe button and hit the little bell after it, and you'll be notified every time I post a new video. And guess I also have a whole bunch of free downloads in the description box below my video. All you need to do if you're on a mobile device is click the title of this video and the description box will pop open and you can download from there. There's great stuff like a relocation guide, a first-time homebuyer's guide, and a bunch of other stuff down there, so check it out. All right, so what is equity? Well, equity is the percent of ownership that you have in your house. So if you purchased a home for $300,000 and you paid cash, well, your equity is 100%. But most people don't do that. They either put like 3.5% down with an FHA loan, or many people try to avoid paying PMI and will put 20% down on their loan. So that leaves, between 96.5% and 80% of the loan that's owned by the mortgage, and you only have that small portion of equity in the house. The first strategy is simply time. You'll be paying your mortgage and paying down the principal on the mortgage, and then homes typically increase in value over time. As you live in your home and the value increases and you're not taking on any more debt, that value belongs to you and that is considered equity in your home. Okay, the second way that you might consider increasing the equity in your home is to simply either pay a little bit more each month on your mortgage. Just to give you a simple example, if you pay just your mortgage, so if you took out a mortgage for $120,000 over the life of the loan, you would be paying about $98,000 in interest alone. So if just by paying the equivalent of one extra mortgage payment per year, you can knock several years off the life of your loan and many thousands of dollars in interest payments. You don't have to do this in one lump sum. You could divide that mortgage payment into 12 parts and just tack that little extra piece onto each mortgage payment, specifying with the bank that you want that to go toward principal, and it would have the same effect. Or you can make a decision just to pay a little bit extra every month on your mortgage, like an extra $100 or $50, $25. On my blog, I have an example of how this could reduce your interest payments and reduce the life of the loan. What I like about this one is that it's flexible and it's voluntary, meaning you're making the decision to make that extra payment, and if you don't have the money for some reason, you've lost your job or your financial situation changes, you're not locked into that higher payment, but you can make it automatic so that you don't have to think about it anymore. And that kind of takes the stress off of having to make that decision if you want to spend that extra $100 on something else every month, or if it's going to go straight to your mortgage. So you can have some flexibility and still maintain the great effect on reducing the term of your loan and the amount of interest that you pay. All right, so another option would be to refinance your loan into a different term, and typically we think of a 30-year term, or sometimes people will get a 15-year term on their loan. The 15-year term obviously cuts your mortgage time in half. Your payments will be more, but generally they charge you less interest for this. So you're paying less on the life of the loan overall. You're paying off sooner. If 15 years doesn't work for you, I do know of mortgage lenders that I work with that will do pretty much any off-year term that you like. So if you want to pay like a 20-year mortgage or an 18-year mortgage, they can give you rates on those terms as well. And this one kind of forces you to achieve your goal. You are locked into that payment and expected to pay it, and to avoid default. You don't have the flexibility that you would have if you did what I talked about in option 1, where you're voluntarily tacking a specific amount of money onto your mortgage every month. Okay, here's some fun ones. Another way to add equity is to renovate the interior. And I say renovate the interior, I don't mean like blow out walls. You could do simple things like keep your paint fresh, update light fixtures or bath fixtures. So if you have crusty old bathroom handles, you can buy a fixture at Home Depot for $100 and it's going to, make the bathroom look that much more updated. So freshening things up really is important. If you do want to do more of a major renovation, the two hot spots that really get the most return on the money are bathrooms and kitchens. So that's one option. And then the final option is also very simple, and it can be free or low cost, which is to update your curb appeal. And by curb appeal, I just simply mean like making sure the exterior of your home is looking well cared for. It doesn't have to be fancy. You don't need fountains and all kinds of stuff. But if you plant some flowers, trim your trees, make sure that there is no peeling paint or rotted wood on the exterior of your home. A nicely painted front door goes a long way toward making your house look welcoming. I actually love my power washer to clean steps and sidewalks. Just keeping the lawn mowed and that kind of thing, because value is more than square footage. It really is about perception. And when people see your home, whether that's a buyer or an appraiser, deferred maintenance rings a lot of bells and also makes your home less desirable. And that desirability is what drives value. So those are ways to increase equity in your home. I hope you liked this video. If you did, I would love to see you back here next week. Thanks so much for watching.